From the morning reading, the S&P 500's thrust came on day 4 of an attempted rally, which along with volume and price gain qualify as a follow-through day. A follow-through day confirms that an uptrend is underway. This means quality stocks now can be bought as they break out of valid bases and bounce off the 50-day long line in strong volume. Individual investors should proceed deliberately, trying to a buy or two. Not all follow-through days work. However, since gut feelings are useless in the stock market, investors should always test a rally. Neither jumping in aggressively nor refusing to buy anything else makes sense. Next. Choppy markets with some large declines have triggered irrational pessimism towards stocks. When we look at the major sentiment surveys and remove the pessimism that should occur given the decline in stocks, we can estimate how irrational investors have been. Since late August, their irrational pessimism rivals any over nearly 30 years. And again, Friday was the 7th time that SPY stocks, TLT bonds, and GLD gold all rallied at least 0.25% on a non-farm payroll day. For what it's worth, stocks struggled in the short term after the others, and there's 6 different dates. And then next, today has the potential to be the initial kickoff from the test of the August panic. If this is the case, then we should see little or no selling pressure early next week. A market that continues to rally in the face of shorter-term overbought readings tends to keep rallying in the intermediate term. So we'll be watching for this next week. And then finally, our technical assessment for some time is that we are in a bear market. To make matters worse, fundamentally, the market is overvalued and earnings are declining. This reinforces our belief that the bear market is far from over. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day from the key U.S. financial markets. It is 7:08 a.m. Central Time, and I'm recording this in preparation for the market day of October the 5th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So, we took a look at several headlines in the morning reading, and a number of them went at the current situation, but looked at it from different perspectives. And one of the things to kind of keep in mind is that just where are we in terms of this bounce and so forth? Is this the bottom? And you might recall that when we had this bottom here, we expected that there would be a retrace of the bottom. Well, we got that retrace of the bottom last week, and from that point, we've now had 4 consecutive days of upward move, including a follow-through day as defined by IBD with sufficient number of days as well as volume coming in to give us that follow-through day. And that, as a result, gave us an IBD status that flipped over to confirmed uptrend. We'll talk a little bit more about that in just a moment, but the big question on everybody's mind this last weekend as I went through my morning readings and other things that I do was, well, is this the bottom, and are we now off to the bullish races and resume the very long-term bullish trend, or is this just a bear setting up a trap for the bulls as they get gleeful just in time to be rolled over on? Well, and when you think of things like the fact that the market was overvalued, and there I think talking about a PE ratio there, and earnings are declining, that certainly doesn't set us up for a great earnings season, which is about to get going in earnest. You also have this kickoff from the August panic, and on the flip side, obviously you've had this follow-through action and so forth, and if during the course of this week we continue to be able to have momentum, well, then that would say an awful lot that the bulls actually have some staying power this time. Of course, it seemed like they had some pretty good power coming through here, and as this ascending triangle formed, there was some expectation that we would continue after this big drop and then this big bounce, a little bit of consolidation by time, and then we'd resume this bullish move, but then that broke down. Well, will we break down once again and basically just form another bear flag as we go down and set new lower lows? Or will the bulls truly be able to power through all this? And we're left with kind of a conundrum as we are facing these two scenarios. So let's go ahead and get into the morning report. Indeed, through the Sunday night, overnight into Monday morning, we've had continuation, and all four broad market indices in the United States are up sharply, about 0.75%, and really there's not any substantial difference between any of the four. You also have crude oil also up about 0.75%, all at the same time that the euro dollar is essentially scratch. So that's kind of an interesting dichotomy right there. In terms of bonds, they're down about 0.33%, and you have gold down about 0.5%. So risk on is the order of the day in terms of the overnight action thus far. And this is reinforced by action from overseas, where you have China up about 0.5%, Hong Kong up over 1.5%, Japan up over 1.5%, Germany leads Europe in a 2.5% gain, and United Kingdom not far behind. So a very, very strong overnight action from all corners of the bull. And in terms of macroeconomic reports for Monday, you have ISM manufacturing PMI, and that's about it of note from the United States. In terms of Tuesday, we have the FOMC member Williams speaking. And also keep in mind that we had Fed minutes this week. Now keep in mind with Fed minutes that the monthly employment report that came out Friday, that information was not available at the time the Fed minutes were actually drawn up. So the Fed minutes will actually be backward looking in a way that's largely going to be probably ignored much by the market this week. Now, most of the time, Fed minutes can be a red flag report, and it'll certainly be listed as red flag, and it has the potential to have a surprise in there, and people will certainly be carving out the words, looking for any indication as to when they might change interest rates. But at the same time, given the unemployment report, that new information coming into the Fed would likely change the conversation if they were to have that conversation today. So that is on the slate for this week, but may not have the same impact it would normally have. In terms of current volatility conditions, short-term VIX down below a 20, skew down below a 115. We're starting to see these various metrics of volatility really fall. IV percentile 32, 34, 36, 39, again falling. Standard deviation moves were put in by all four the markets on Friday, but they were bullish moves. So there's certainly, again, nothing to be fearful of. So there was volatility, as in price volatility, but it was positive price action, and certainly something that would ebb away the fear that would be reflected in a number of these other metrics. And in terms of the number of standard deviation moves we've had in the last 2 weeks, again, nothing really to get excited about. That's really just about normal for the S&P. So nothing particularly exciting there. In terms of taking other looks at this market, so we've now closed right at this prior swing high, and if you look on the SPY, it closed actually about 3 cents above, so a similar high, not a new high, by 3 cents. So that's kind of the first line in the sand, and with the overnight action, if that holds up through the market open, that would seem to say that, okay, the bulls have been able to take us from the similar low to a similar high and break through that similar high. So one check mark for the bulls. They've got to get through the first line of the sand. Now the next question is, can they sustain that, and can they then take on the next line in the sand? And the next line in the sand, frankly, is going to be this one up here with the post FOMC announcement wick. And can they get through this 2019 area? Now we've got some distance to go between where we are right now and the 2019 area, but really in terms of a technical sense, other than hidden levels like fib retracements and the like, there's not much in the way of obvious diagonal or horizontal resistance in this area until you get up to that area. So we'll see just how well the bulls can muster this next set of moves, and it could be, frankly, quite a bit more challenging than the first set of moves. In terms of the Russell, it's got a long way to go. Remember, it was technically and relatively weaker than the others, so a lot of action, but obviously Friday was also quite bullish there. In terms of the NASDAQ, also needing to make up some ground, and you see in this case the NASDAQ's not even gotten back to the prior swing high. So unlike the S&P, it was bullish, and certainly that's a big green candle there, but it was not enough to get it back to the kind of first line in the sand. So it's got some additional room, and if we don't see the NASDAQ and the Russell lead the S&P, that certainly can be a sign of warning. And certainly if you think about day trading, you know, if we see the S&P, the first one out the gate, we're usually quite suspicious of that move. We like to see the Russell and the NASDAQ leading a big bull move to be able to believe in that sustainability. And then the Dow finally, much like some of the others, well, like the S&P, came in right at a similar high from this move right here. So this pattern here is not as clean as the S&P, but certainly it would seem to be all bulls all the time for most of this last week, and has brought us up in all these markets, you know, into areas that are at the first line in the sand or coming into the first line in the sand, and certainly made a big statement for the bulls thus far. One thing we might want to also look at is volatility. This is the VIX futures. And on the reverse, we would need to see these falling. And one of the things that we're interested in is in bull markets, you get a spike and then a very quick kind of diminishing of that spike all the way back down to prior levels. With bear markets, usually what you see is you see a spike, but then volatility remains elevated and usually doesn't get below a 20. Well, in this case, we came down here to just kind of head fake below the 20 and then elevate it again. It'll be interesting to see, does this actually start to get below a 20 and stay below that 20? In terms of our regular daily report, we've had a number of changes here. We had, with this action on Friday, IBD status went to confirmed uptrend, and we talked about that in the morning headlines a little bit, about how that follow-through day on the fourth day of the rally, you know, was able to change this status from you know, a downtrend into a confirmed uptrend. But keep in mind, as that article mentioned, that, you know, I think it said individual investors should proceed deliberately, trying a buy or two. Not all follow-through days work. However, since gut feelings are useless in the stock market, investors should always test the rally. Neither jumping in aggressively nor refusing to buy anything makes sense. So be very temperate. And indeed, if you look for consensus amongst our various systems, this one's kind of out in front. GMI index is still a 1 out of 6, so that's an improvement by 1 notch. but that is still a sell signal, and it has been a sell signal since August the 24th. That author remains in cash. The primary market condition still remains as strong bear. The stock chart's decision point scoreboard still remain a sea of down red arrows, including the short term. And you have, with the intermediate term market posture, it's weakly bullish. So this is certainly not, if you put all this together in a consensus, not a all bulls all the time kind of signal. It is a very, very tepid, if you might, sign for the bulls to be able to test some initial probing positions and see how they perform. And that probably is the best way to go forward. So from a position sizing opinion, based on that IBD, it does say portfolio exposure can be up to 100%. From a volatility standpoint, it does say up to 75%. So obviously some improvements there from what we saw early last week. And yet at the same time, we would probably overrule that mechanical signal into something a bit more tepid. Indeed, look at the intermediate term market postures. We said weekly bullish. Well, it is just weekly bullish by the most narrow of margins. The S&P is at a 20.2. If that was a 19.9, that would still be bearish. Also, you have Dow at 39.8 and NASDAQ at 40.9. So those are a little bit relatively stronger, but the Russell remains in bearish territory at a 13.2. So most important one, of course, is the S&P, and it is the most tepid weak bull that you can have. In terms of overall hedge warning status, we have this as a threshold level 1. So dramatically reduced from what we had at the end of last week with the level 3, and we said at that time that the risk levels were elevated, and certainly conditions were present that a significant breakdown was possible, though with the hedger's status we do not predict a down move, nor do we predict how far that down move would go. And indeed, if we're truly in a bullish market, it is right there at that edge where the risk levels are the most elevated that the bulls must come in and rescue the day. And indeed, that is exactly what they did last week, and took us away from that knife edge and that elevated risk level where we could have really fallen through. And if we had fallen through, we most surely would have gone back to last October lows. So we have to recognize that those conditions have changed. Risk levels have alleviated to some degree since then, but they're still elevated from normal, normal being a 0. We would still call this threshold level 1. Along with the upper metrics, a number of the lower metrics also came off. Volatility statuses, as the cross relation status, went to, okay, and that's the first time we've seen that warning ebb off in some time. Also, the short term to intermediate term relationship, that also went down to okay status. The VIX futures daily squeeze, no squeeze present, nothing really there to be warning about. Volatility ratio, actually that's an okay. Skew, okay, all these different metrics, kind of came off and ebbed off. Indeed, if you look at the expected move in the SPX this week, right now it's at a 41, and this is the least that's been priced in by the option makers in a month at this point. So kind of keep that as another sign that volatility is ebbing, fear is ebbing, and certainly the premium that's being priced into the market for that fear is also ebbing. We did have a couple warning signs. Obviously, the VIX is still up over an 18. New York Stock Exchange, new highs, new lows. Still, even with that big bullish candle of Friday, still had a significant number of new lows actually put in. And that kind of speaks to the fact that we continue to have really poor breadth. And when you look at just a handful of companies, on whether you're looking at the S&P, or you're looking at New York Stock Exchange, or you're looking at the NASDAQ, there's just a small number of companies that are holding up this market and giving us these bullish readings. If you look at the S&P 500, for example, while the overall correction in the S&P was down like 12.5%. A majority of the individual components that make up those 500 companies in that list are in bear market territory. That is to say that they've dropped more than 20%. So these upward moves have not been universally advanced across all the companies. Not everybody has been a winner to the same degree. Also, other warnings still, the intermarket risk aversion indicators, all 5 of these are still risk off. Special opinions, we've had some changes here with the action from this last week. Option income strategies, the VIX is still outside the acceptable window for novice traders, but for aggressive traders you can consider reduced position size and the potential for higher than normal delta and vega moves. Certainly could start to think about initiating some new positions as we come down that hedge risk level down to level 1. In terms of covered calls, conditions are cautiously bullish and acceptable to initiate new positions for novice traders using a 1-for-1 ratio of in the money and out of the money strikes. Consider reduced position size, legging into your covered calls through well out of the money put selling. If you're used to doing the cycle, you might want to put that into play at this point. Perhaps a mix. So maybe you enter a couple or 1 or 2 high beta covered calls, maybe 1 or 2 low beta covered calls, using that 1-to-1 ratio of in the money and out of the money strikes. Maybe you also want to leg in to a position by selling a put, and perhaps even defining the risk on that put by spreading that, and then keep the position size ultimately in the scale that you are absolutely willing to own should this roll over and back into an outright bear market, that you would be willing to own all those shares for the foreseeable future. And then from a put selling standpoint, again, cautiously bullish, acceptable for new core put portfolio positions. Consider reduction of size, defined risk. Aggressive traders consider scaling into full size positions. In terms of the relative rotation graph, couple interesting things here. There are some green shoots here, as there were. I mean, XLU, ITB, FDN, IYR, are all as it were green and in the right quadrant. They're not the strongest shooting stars that you would like to see. You'd love to see this action where you're going from this direction in the bottom left into the upper right. That's your strongest signals, and XLU is certainly elevated in terms of momentum and certainly moving up, but yet it's kind of weakening at the same time in terms that it's kind of falling off of its upper ratings. IYR is doing the same thing. ITB slightly down. FDN would seem to have rolled back. So none of these, while green and all in the upper quadrant, are super confidence boosters in terms of being able to initiate new positions at this time. So kind of just keep that in mind. Other aspects of looking at sector market posture from the different time frames, notice consumer discretionary, consumer staples, and utilities, kind of leaders of the pack. Energy certainly has had some pretty remarkable short-term to intermediate-term recovery, so recognize that as well. Telecom, down, 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 so a laggard sector there. If you think that this is a bear market and this rally is just an attempt to reload, you might want to look at what's down, 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 and that might be a target for initiating of short-term bearish kind of swing setups. And you see energy here up 4% on Friday, materials up almost 2.5%, healthcare about 2%. So some of the areas that were most beaten up in this last bear market swing are some of the strongest recovering. So we'll continue to see how that plays through. I mean, energy actually for the 1 month time frame now is actually green. So has a long way to catch up. You see the 1 year down 27%, but certainly bottom's got to start somewhere, and certainly that one has shown some promise here of late. That is probably enough for today. We went very long, but we had a lot of really important changes to take into play. Also, a reminder, just 1 week out, this course is going to be available. This is a 40-hour course titled Self-Directed Active Money Management, and this is done in collaboration with the Chicago Northwest Burb Trading Club. It's a 10-week course with some bonus material, total of 43 hours of educational material. It's the 9th time that our friend Nick Fosco has taught this course, so he's definitely got the course dialed in. The course will start on this Saturday, October the 10th, and will run 9 to 1 each day in the Chicago suburb of Schaumburg. It will be simulcast to the web, so if you're not in Schaumburg or Chicago, for that matter, no worries. You can participate in the course if you'd like through the simulcast, and you won't miss out on anything. Details for the course description and pricing and all those kinds of things can be found at this website, so be sure to go there and check that out. As always, if you find what you're getting from here is helpful, please retweet us to your Twitter followers, to your StockTwit followers. Like us on YouTube, subscribe to us on YouTube. We like that, and gives us a little charge every time we see one of you do those things, and we note each and every one of those. I guarantee it. The feedback can be sent to support@falconglobaltraders.com. Disclosures, as always, hit the pause button if you need more time to review this. And we'll see you back here tomorrow morning before the market opens with the Falcon Global Market Preview. Good trading.